Hey everyone, and welcome to The Explainer. Today, we're mapping out a fascinating dual-front transformation that is quietly but fundamentally reshaping the life of the American worker. Basically, we're going to look at massive changes in how we actually earn our paychecks, combined with a somewhat hidden shift in where those hard-earned savings go once we invest them. We call this the worker's double squeeze. It's definitely a complex topic, but by the end of this explainer, you're going to have a perfectly clear picture of the forces at play.
I want you to start by asking yourself this very real question. Is your paycheck safe today, and will your 401k be safe tomorrow? It's a massive question for literally anyone in the workforce right now. Because on one side, we have this relentless wave of workforce automation, which is rapidly rewriting the rules of human labor and making certain skills totally obsolete. And then, on the exact flip side, we have Wall Street and private equity moving directly into everyday retirement plans, completely changing the risk profile of your nest egg. Today, we're bringing both of these forces out into the light.
Okay, let's dive right into this. Here's our roadmap for the explainer. First, surviving the automation wave. Second, rethinking job training. Third, your 401k's new guest. Fourth, diversification or liquidity trap. And finally, the balancing act.
Section 1. Surviving the Automation Wave. Let's kick things off with a comprehensive report from the U.S. Government Accountability Office, the GAO, examining workforce automation. And when we say automation, we aren't just talking about robotic arms in a car factory. We're talking about algorithms doing tax preparation, self-checkouts at the grocery store, and software managing electronic records. This idea is spreading like wildfire. This massive report highlights a stark contrast in the modern workforce. On one hand, we've got jobs at the highest risk of being automated away. These are your routine, clerical tasks, cashiers, essentially jobs built on predictable, repetitive actions. On the other hand, we have the safe jobs, management, nursing, and roles requiring deep social interaction. The GAO makes it super clear that the more a job relies on nuanced human interaction, empathy, and complex critical thinking, well, the safer it is from being handed over to a machine or an algorithm.
What's truly fascinating here is how we can quantify this shift using Department of Labor data. The GAO broke down specific skill categories, and honestly, routine skills have a definitively low demand going forward. But look at process skills, things like active learning and critical thinking, and social skills like interpersonal management. The demand for these is absolutely through the roof. The data also explicitly links these high-demand, automation-proof jobs to higher levels of education. So the modern economy doesn't just care about what you currently know, it cares deeply about how quickly you can learn and how well you interact with others.
Section 2. Rethinking job training.
So if process and social skills are the ultimate escape hatch from workforce automation, how do displaced workers actually go about learning them? Well, the GAO found a massive roadblock in our current system. I want to read this exact quote from a state official featured in the report. They noted, "Some programs focus on interviewing and resume writing skills rather than helping workers acquire the actual skills needed." Actually, just think about the stark irony there for a second. We're teaching someone to format a resume for a job that a machine literally just took over. Workers whose jobs are being displaced by automation are being pushed into training programs that teach them how to apply for jobs, but not necessarily teaching them the complex, high-demand cognitive skills required to actually perform those new jobs. Teaching someone to draft a cover letter does not teach them active learning or critical thinking.
To fix this severe disconnect, the GAO outlined 4 specific strategies. First, we absolutely must laser-focus training content strictly on those in-demand process and social skills. We also have to maximize program accessibility. Think about providing childcare so displaced workers can realistically attend these training sessions. Combine that with direct financial investment into this training infrastructure and intense collaboration across all workforce stakeholders, businesses, educators, and government agencies, all working from the exact same playbook. And we finally have a modern path forward.
Section 3. Your 401k's new guest.
Okay, let's pivot now from how you earn your human capital to how you save and protect your financial capital. Back in 2020, a highly controversial U.S. Department of Labor information letter fundamentally changed the landscape of everyday retirement accounts for millions of Americans by inviting in a brand new guest, private equity, or PE. Private equity involves investments in privately held companies, so companies that are not traded on the public stock market. This asset class is characterized by longer time horizons, highly complex organizational structures, and limited liquidity. This basically means you can't just easily buy and sell your shares on a standard exchange whenever you want. Your money is locked in for years to help these private companies grow.
Let's see how this builds across a timeline. Why is private equity entering your 401k right now? Well, over the past 20 years, we've seen a noticeable reduction in the number of public companies. Think about it.
Massive tech companies are staying private way longer before their IPOs. Because companies are accessing private capital instead of public markets, regulators felt a lot of pressure to give everyday workers access to that early-stage growth. So in 2020, the Department of Labor issued guidance opening the door for private equity to be included in 401k plans. Today, we're seeing PE slowly enter professionally managed asset allocation funds, like the standard target date or balanced funds that so many of us auto-enroll in.
Section 4. Diversification, or liquidity trap.
As you might guess, this regulatory shift has sparked a fierce, industry-wide debate. First, let's examine the Department of Labor's case. The DOL argues that adding private equity enhances overall retirement outcomes for the everyday worker. So the crucial point is that it brings institutional-grade diversification to everyday participants. Because private equity doesn't always move in tight lockstep with the broader public stock market, the government argues it can act as a crucial hedge against sudden market downturns. Most importantly, it gives workers a slice of the potentially massive returns generated by early-stage, fast-growing companies before they ever go public.
However, there is severe pushback against this narrative, and this brilliantly illustrates the opposing view. We're pulling from an excerpt titled "The Private Equity Raid on American Retirement," which states, simply, Wall Street is subsidizing high-risk bets with your retirement. Critics are sounding a massive alarm here. They argue that traditional institutional investors are backing away from private equity due to liquidity issues, and as a result, PE firms are turning to the massive, captive pool of American 401k contributions. They view this as a way for Wall Street to lock up your money to fund their own risky ventures, often without the explicit, informed consent of the everyday worker.
Let's place these two forces side by side so you can see the tension clearly. The DOL views this integration as a totally legitimate way to secure diversified institutional-grade returns over a multi-year period, mimicking the successful portfolios of large pension funds. The critics? Well, they view it as a complete liquidity trap. They argue that your retirement capital becomes trapped in opaque structures with high complex fees, subjecting workers to unconsented high-risk bets. It really is a profound debate between the potential for greater long-term growth versus the very real danger of locking up your life savings in an illiquid asset.
Because these risks are so vastly different from traditional stocks, the Department of Labor laid out incredibly strict fiduciary guidelines. Plan managers have to objectively evaluate these complex fees. They also have to mathematically guarantee enough liquidity so you can actually withdraw your money when you retire, take out a loan, or change jobs. And perhaps the absolute toughest hurdle? Securing an independent daily valuation for companies that aren't even traded publicly. Establishing a fair daily value for a 401k balance under these conditions requires significant, complex judgment.
Section 5. The Balancing Act.
We've covered a tremendous amount of ground today, exploring the two massive forces bearing down on the modern worker. The reality of our modern economy is perfectly summarized right here. You cannot be passive. You must actively manage your human capital against the relentless tide of automation, which means consistently updating your critical thinking and social skills. Simultaneously, you must actively manage your financial capital against complex Wall Street risks, taking the actual time to understand exactly what is inside the target date funds you're trusting with your retirement. The days of set it and forget it are completely over, both in your career and your portfolio.
Which leaves us with one final vital question for you to consider. Are you ready to manage the future of your skills and the true cost of your retirement? I highly encourage you to audit your own job training trajectory, embrace those in-demand process skills, and take a much closer look at your 401k allocations today. Knowledge truly is your best defense. Thank you so much for joining me for this explainer, and I hope this helps you stay ahead of the curve. Keep learning.